Joining me now is Tom Hayes. He is the chairman and managing member of Great Hill Capital. We have just about a minute before the bell, but what are you looking forward to in today's session, Tom?
Yeah, I think, Ashley, first of all, thanks for having me. I think the big story today is coming off of Chairman Powell's comments yesterday, where he kind of alluded to the fact that he thinks the market is a bit fairly or fully valued or overvalued. And the market didn't take well to that yesterday. I think what we have to look at here is what aspects of the market. Because if you just look at indices, which is predominantly Mag 7 weighted, 22.5 times earnings, 13.7% earnings growth, I think he's right. I think if you look under the surface and you look at all the opportunities in small caps, you look at value, you look at healthcare, some of the beaten down sectors, healthcare, energy, international, the opportunity is second to none. You know, just looking at today, you saw Alibaba is up, 8-9% pre-market. They released a new AI large language model called Qwen 3.0 Max with 1 trillion parameters. International stocks have been outperforming the U.S. 2-to-1, Chinese stocks 3-to-1. So I'm interested to see the market's reaction on the day after.
We're gonna go to the bell now. We're gonna talk more about that when we come back. The markets are officially open for trade. Rejoining me now is Tom Hayes. Tom, let's get a little bit deeper into that first point that you brought up. Fed Chair Jerome Powell said stock prices are, quote, fairly highly valued. What are your thoughts on that assessment?
Yeah, I think, this is reminiscent of Alan Greenspan in 1996 when he said irrational exuberance in the stock market. He was 4 years too early on calling the top. So I think Chairman Powell makes an important point about some of the stocks. So if you look at Mag 7, which is 40% of the weight of the S&P 500, they have decelerated their earnings growth from over 30% last year to about 10 or 15% this quarter, half the earnings growth, but the multiple has stayed elevated at 33 times earnings. So in those pockets where you have decelerating earnings and a very high multiple, a higher than market multiple, I think he's absolutely right. I do think, though, as we look at rates coming down, which is helping the cyclicals, helping the unmagnificent 493, helping small caps. Small cap stocks right now are at a once in 25-year opportunity. So in the last 100 years, this is the fourth time that small caps have traded at such a low valuation relative to large caps. Every time you bought the small cap index during these periods, you had dramatic outperformance over the next 5 to 6 years. We saw the same thing from 2001 to 2006. So what are the conditions precedent that create the opportunity in small caps? Rates coming down into an expansion allows these companies to refinance debt, because at the small cap level, that is the biggest risk, is solvency risk. So this is going to be a huge opportunity. Small caps, 35% earnings growth next year, 17 times multiple, the exact opposite of the Mag 7. So as he points to the indices, he's right. As he points to under the surface, there's a tremendous amount to do.
And what's your take on the 25 basis point cut, and what do you think is going to happen for the rest of the year? People are saying perhaps 2 more cuts before the end of the year and into 2026.
Yeah, I think 25 basis points was too little. He's still 200 basis points too restrictive. The thing about the labor market, which he's now acknowledging, it's like boiling a frog in the pot. You don't feel it until you feel it all at once. Once layoffs start, they tend to cascade very aggressively. So they need to get ahead of it. They need to get these next 2 cuts in. But what we found historically is when they cut 4 or 5, they restart the easing cycle into expansion with 4 or 5 cuts over a 12-month period. On average, the market is up 16.1%, S&P up over the next 12 months. So I do think we have conditions precedent. I think President Trump might find that too late Powell turns out to be just in time Powell if he gets the 4 to 5 cuts in, and it's going to reaccelerate the economy quickly.
And you know it's hard to believe because Q2 earnings season just ended, but there's another one, Q3 earnings right around the corner. What are your expectations for it?
Well, it's really interesting. Usually expectations have come down into the quarter. Expectations are actually going up. A couple months ago, 7.2% earnings growth expected, now 7.9% earnings growth. Same thing for next year. It went from $300 a share to $305 a share. So estimates going up. I think they're still conservative. I think we will beat. I think what people are going to be a little bit surprised by this quarter is if you look year on year for the growth rate of earnings for the Magnificent Seven, they're going to be a lot more subdued because all that CapEx that's going into AI is impacting earnings, impacting their ability to buy back shares. So I think that's going to be kind of the nuance. You have these unloved stocks that are now part of the catch-up trade that managers have to be in because they all sold in the hole in April, and now they have to catch up to their benchmarks with performance. They're not going to do that in Mag 7, which have already had the run. They're going to do it in those stocks that are just getting going right now. So I think that's the one thing that I would be focused on. What does earnings growth look like with all the CapEx spending in the Mag 7? How does that affect the indices, and where are the opportunities going forward? Meaning those plays that will benefit from AI, not be the ones making all the investments in AI and compressing their margins.
And I know you touched on small caps, and it seems like every expert that we have coming in is now talking about small caps. The Russell just hit a record. Do you think they're being overlooked?
Yeah, I do think they're being overlooked because people don't trust it. There have been a lot of false starts over the last few years. I think the only thing that could make them come out of the penalty box was the restart of the easing cycle. And now that we're seeing that, I think we're going to see a huge amount of growth. Look, the earnings don't lie. 35% earnings growth at a half that multiple, 17, 18 times, you have to have some exposure. And then they're bifurcated between those that are profitable and those that are unprofitable. Obviously, the profitable ones are dramatically outperforming. But we're loading the boat in some of these stocks. Like, for instance, a covert play that we have on AI is natural gas play called Comstock Resources. No one wanted to talk about this, a year ago when we were buying at $8 and $9. Jerry Jones, who owns the Dallas Cowboys, he made all his money in energy to buy the Cowboys. He owns 75% of the stock. They have 1.1 million acres in Louisiana and Texas, near the export terminals, near the liquefaction terminals. And if you believe Goldman Sachs that data center growth demand is going to be 165% by 2030, and natural gas is going to power 60% of that, you definitely want to have exposure to natural gas and in the small and mid-cap sectors.
And I understand that you are bullish on energy. Can you talk a little bit more about why?
Yeah, so the weighting of the energy sector in the S&P 500 is at historic lows. The last time it hit 3% where it is right now was in 2020 during the COVID lows when energy prices actually went negative. They were paying people to take barrels of oil in 2020 during COVID. If you bought energy stocks during that period, you made a tremendous amount of money over the next 12 to 18 months, and now you have the AI tailwind coupled behind it, along with the administration's favorable policies.
All right, Tom Hayes, chairman of Great Hill Capital, thank you so much for joining us at the New York Stock Exchange.
Thank you, Ashley.